Good morning, everybody. Hope you're having a good day today. Today we're going to deal with Chapter 4 in the text, and most of what's in Chapter 4 deals with the auditor's report. So after the auditor has completed their audit of the financial statements, we know that they have to prepare a report on what they found. So Chapter 4 is PowerPoints. Once we get into it, we'll talk about the independent auditor's report. But I thought it would help us today if we started off by actually looking at an actual auditor's report. And I'll point out a number of things in the report, which will be discussed as we get into the PowerPoints a bit later today. So this particular auditor's report is posted in Blackboard resources, so you can pull it up later yourself. It's part of the annual report of the CIBC Bank, so Canadian Imperial Bank of Commerce, one of our major banks in Canada. And I'll just scroll through and give you some explanation for the various headings. And after I've made some comments with respect to the auditor's report, we'll go into the actual PowerPoints, okay? So starting here, we see that when the auditors prepare the report, they actually have a heading for the report, typically just called Independent Auditor's Report. Other than a few years ago, it used to just be called Auditor's Report. But you see now the word independent is added in there, which comes back to the importance of independence, right, of auditors in their relationship with management. So we're highlighting now in the heading that this is an independent auditor's report. So we're telling the reader, oh, by the way, we are independent, right? And of course, it's referring to independent of management. And it's a report to the shareholders of the company and to the directors of the company, because the directors have hired the auditors on behalf of the shareholders. So it's addressed to both parties. It's kind of interesting. I often thought for years myself that it should be directed to both parties, but for many years it was only directed to the shareholders, not to the directors. So now it's directed to both. Now, in terms of the format, the auditor's report has been greatly expanded, right, from the 1970s style. The 1970s style was just the two-paragraph audit report that we looked at previously. And so in this case, it's been vastly expanded and consists of many, many pages. So the first heading we see, and the report is organized by various headings, as you can see in red ink here. So the first one is the opinion. And in the opinion, we'll just read some of the words. It says, we have audited, right? So the auditor is telling the reader of the financial statements the nature of the work that they've done. They've actually audited the consolidated financial statements. And then we denote what do the consolidated financial statements consist of. They comprise the consolidated balance sheet as at October 31, 2020 and 2019, the statements of income, statements of comprehensive income, statement of changes in equity, and cash flow for the years in the 3-year period ended October 31, 2020, as well as the notes to the consolidated financial statements. So in the older audit reports, we never said that the notes had been audited. It just referred to the financial statements, assuming, right, that the readers understood that the financial statements included the notes. So again, transitioning the wording over many years, the direct reference to the notes has been added into the auditor's report. And the notes actually include a summary of the significant accounting policies. And as you see in brackets here, collectively referred to as the consolidated financial statements. So the auditors are trying to make it very clear that the consolidated financial statements consist of the actual numbers, right, the balance sheet, statement of income, etc., right, as well as the notes to the financial statements, including the accounting policies. All of that taken together is what the auditors are referring to when they use the words consolidated financial statements. Then in the opinion paragraph, they have to actually state what their opinion is on the consolidated financial statements. In most cases, the users are looking for these keywords, that the financial statements present fairly. Okay, we're going to talk a bit later today about the fact that sometimes auditors have to modify their audit report and say something other than the financial statements present fairly. But again, we'll talk about that a bit later in the class. So in this case, the financial statements present fairly, and then it says in all material respects. So the auditors are trying to tell the readers here that the financial statements, they're not a 100% guarantee that the numbers are absolutely correct, right? But it says in all material respects. So what that really means is that the reader can rely on the financial statements, and that the financial statements are close enough, right, to being totally 100% accurate, that the reader can rely on them. If there is any difference, the auditors are inferring that the difference would not affect the reader's decision, right, based on the financial statements. And so the financial statements present fairly in all material respects. And then we also have to say what the standard is that we are reporting on in the financial statements. So the financial statements present fairly in accordance with what criteria? Well, in this case, in accordance with IFRS. Okay. The next main heading, basis for opinion. Okay, in our opinion, we're saying that the financial statements present fairly, but how do we actually know that the financial statements present fairly? So we want to tell the reader, what's the basis for our opinion? What's the foundation? Right? What's the reasoning behind the fact that we say the financial statements present fairly? So in the next paragraph, basis for opinion, says we have conducted our audit in accordance with, in this case, Canadian generally accepted auditing standards. Again, keep in mind, in Canada, we've adopted the international standards. So as we're going through the course, the Canadian standards and the international standards are the same thing. But we're in the Canadian reporting environment here, so that's why they're referring to Canadian generally accepted auditing standards. Our responsibility under those standards, so the auditor's responsibility, are further described in auditor's responsibility for the audit in the consolidated financial statements. So we're going to see in a few more minutes, there's actually another heading where the auditors expand upon what they did, what their responsibilities are, okay? But we're just saying the basis for our opinion is the audit that we did in accordance with generally accepted auditing standards. The next sentence, it says, we are independent of CIBC in accordance with the ethical requirements that are relevant to our audit of the consolidated financial statements in Canada. So again, in the older audit reports, we never talked about being independent, but now we specifically draw attention to the fact that we are independent, right? So obviously, the auditors feel that's pretty important. And of course, the readers should realize that the auditors are independent, right, of management. That's important for them to realize it. And now we actually tell the reader that we are, and that we're independent in accordance with ethical requirements. Again, in the older audit reports, there was no reference to ethical requirements. Probably many readers had no idea that auditors were bound by ethical requirements. So we're actually stating here that we're following our ethical requirements. And then we say we have fulfilled our other ethical responsibilities in accordance with those requirements. Well, what are the other responsibilities? Well, we talked the other day, right? We have to maintain the reputation, right, of the profession. We have to be objective. We need to have integrity, right? All those other standards in addition to independence. We're actually telling the reader we've met all of these standards that are required by our professional body. One of the key things that we also say in terms of supporting why we give the opinion or present fairly is in the next sentence. It says, we believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our opinion. So we're telling the reader, by the way, we have evidence, right? So we just didn't give our opinion blindly. We have evidence. What type of evidence? Well, we have evidence which is sufficient. That means that we have enough of it. It's a quantitative measurement. And it's appropriate. Appropriateness goes towards the quality of the information, right? So we're saying we have sufficient, we have enough quantitatively in terms of audit evidence, and we have the right type, right? The nature of our audit evidence is such that when you take the right amount of evidence and the right quality of the evidence, that provides the basis for the opinion that we gave with respect to the financial statements presenting fairly. In terms of the key audit matters is actually something that's fairly new in auditors reporting. Again, just a few years ago, we did not have a paragraph called key audit matters. And so during the course of the audit, of course, the auditors are making various judgment calls, right? There's a lot of accounting estimates that are used, right, in the preparation of the financial statements. So the key matters paragraphs are a way in which the auditor can draw attention, right, for the reader that there are some areas where they've used significant judgment, okay? And of course, that's what they're trying to do here in this particular paragraphs. And again, you can see you can have multiple paragraphs, right, when you're talking about key audit matters. It's not just one, okay? And so when we talk about key audit matters, there's various items that the auditors are drawing the attention to for the users. So one key audit matter is the allowance for credit losses. So here the auditors, again, we're not going to go through all the wording, but the auditors are just saying, oh, for a bank, right, because they lend money, there could be an issue with respect to credit losses, right? So we're using a lot of judgment in determining the amount of the allowance for doubtful loans that might exist at the balance sheet date, right? So the readers are aware, oh, maybe that's an area that we should consider when we look at the financial statements. It's a risky area, right? So we're making the reader aware of that. The second one, key audit matter, fair value measurement of derivatives. So derivatives, we know, are one of those things in accounting which are difficult to measure. And the fair value of those are influenced by interest rates, for example. And we're drawing attention again to the reader that, oh, by the way, the valuation of derivatives is a high risk area, right? Which again, as the reader, you should be considering. Now, in each of these areas, we're telling the reader, yes, these are high risk areas, but we're also telling the reader, you can see how our audit addressed the key audit matter, right? So we tell the reader, not only is there an area of high risk, but we have to do something about it, right? So we actually tell the reader in these various paragraphs how we responded to the increased risk presented by, for example, credit losses. And then with respect to the valuation of derivatives, same thing. How did we address the risk presented by that key audit matter? Income tax provisions are considered to be a key audit matter. The reason that tax provisions are a key audit matter is that is there income tax law in each country where CIBC operates? Yes, but sometimes it's the interpretation of the law, right? And so a company may file its tax returns based on its own interpretation of the law, but at times the government may disagree with how the company has filed its tax returns and reassess, right, and say we want more money. And in that case, of course, sometimes the companies have to pay, sometimes they don't. They fight it in court. So there could be uncertainties in the measurement of the amount of tax that we owe. Again, we tell the reader, how did we respond to that risk? So by telling the reader how we responded to the risk, the reader can say, well, was that enough work or not? Maybe I should, again, pay attention to that data that's recorded in the financial statements. If I think the area is more risky, maybe I should allow an extra $1 million, right, in income taxes payable when I look at the balance sheet, right, or when I look at the income statement for the year. Right? I'm going to make my own assessment with respect to the effect of this risk on the financial statements and my interpretation of the numbers. Another area of high risk they draw attention to is goodwill impairment. So we know that, again, in accounting, difficult to measure impairment losses. So again, we tell the reader, right, how we responded to that risk. And for each of these key audit matters that are brought to the attention of the reader, right, in terms of how we respond, it's just not one paragraph, right? There's multiple paragraphs in terms of what the auditors have done in each of these risk areas, right? So it's not a case where we said, oh, here's a big problem, and we just did a little bit of work. No, the auditors did a lot of work, right? As evidenced by the fact that there's multiple paragraphs involved in terms of addressing this risk. Okay, so those are the key audit matter paragraphs. Again, key audit matters, that's only new for about the past 3 years, okay? Before 2017, you never had any reference to key audit matters in auditors' reports. And so the reader, right, was not really aware, right, of the riskiness of some of the numbers. So this is a way that auditors are trying to better communicate, right, what an audit is about, and the fact that in accounting you have to deal with a number of areas which are uncertain, right? And as a consequence, the numbers may change in the future because of the uncertainty and as the facts change, right? So we're trying to communicate in a better manner to the reader, right? Trying to make them more aware of the risks that are inherent in a company's financial statements. Okay, in addition to the key audit matters, you can see the next heading is other information. Right? So auditors can provide additional information beyond telling the reader what's important in the financial statements themselves by having other information. So what's being told in this other information paragraph? It says management is responsible for the other information. What is the other information that the auditors are trying to draw attention to? So 2 points here, management's discussion and analysis. So normally for a public company, the audited financial statements are included in what's called the audit report, right? And so the audit report is contained within the annual report. The annual report typically is, 150, 200 pages long for a public company. The financial statements themselves only typically maybe take up, 30, 40, 50 pages, depending on the company. So there's a lot of additional information contained in the annual report. Who's responsible for that information? The auditors are saying, oh, by the way, management, right, is responsible for all the other information in the annual report. The auditors are not taking any responsibility for other than anything that's in the financial statements themselves. So management's responsible for what's called the MD&A, Management Discussion Analysis. And then in addition to that, it says the information other than the consolidated financial statements and our auditor's report thereon in the annual report, right? So they're not only just responsible for what they say in their MD&A, they're responsible for everything else, right? They put into the annual report. So that it may be things like human resource report, right? Policies that the company has, new things that they've put in place. Okay, so you can be talking about environmental responsibilities and what they're doing there. So all kinds of additional information outside of management's MD&A can be included in the financial report. Now, they don't talk about it here. I'll just read the next paragraph. It says, our opinion on the consolidated financial statements does not cover the other information. Right? So the auditors are not giving any opinion on management's MD&A, and they're not giving any other opinion on any other information contained in the annual report. It says we do not express any form of assurance or conclusion thereon. Okay, so what the auditors do though, in connection with their audit, is that they read the other information, right? They want to make sure it's consistent with what is in their financial statements. And so the next paragraph, it says, in connection with their audit of the consolidated financial statements, our responsibility is to read the other information, right? So we're telling the readers, we've actually read the entire annual report, and in so doing, we consider whether the other information is materially inconsistent with the consolidated financial statements and our knowledge obtained in the audit, or otherwise appears to be materially misstated. It says we obtain management's MD&A and the annual report prior to the date of the auditor's report, right? So we didn't issue our audit report until we had actually reviewed all the information. If based on the work we have performed, we conclude that there is a material misstatement of this other information, we are required to report that fact in our auditor's report. It says we have nothing in this report in this regard, right? So we're telling the reader we're not taking any responsibility for the other information contained in the report, but we have reviewed it, and we reviewed it to ensure that it is consistent with what is in the financial statements. Because, you know, if management said in the annual report, oh, we're going to have a big loss with respect to a particular account receivable, well, was that considered during the audit or not, right? The auditors don't want to be surprised by any information that management might be giving outside of the financial statements. So auditors review it for consistency, and they do that, of course, before they sign off on their auditor's report. Okay, so this has been done for years. Okay, when I was practicing full time, I often did this myself, right? Reviewing the annual report for consistency, etc. But again, in the older audit reports, we never actually told the readers that we did all of this stuff, right? And so our communication with the readers of the financial statements really wasn't very good, right? I remember when I first started practicing myself in the audit function, looking at our 2-paragraph audit report that we had back in the late 1970s, 1980s, I often thought, no wonder we're getting sued so often, you know, as an audit profession. We're not communicating, right, very well with the users of the financial information and the financial statements in particular. So now, at least we're trying, right, to do a much better job. And that's why we have these very lengthy audit reports. So I'm just going to go back a couple pages here. So if we look at this, the first page here, it's page 101, right, in the annual report. And so far, so 101, 102, 103, right? So we have three pages so far, right, in the audit report. And we go forward to the 4th page. So in the 4th page, we have some additional headings. The responsibility of management and those charged with governance for the consolidated financial statements. Oh, management has some responsibility. Oh, the board of directors has some responsibility. Yes. Again, previously, we never communicated the fact that the financial statements are the responsibility of management, not of the auditors. Very often people thought, because the auditors didn't say anything otherwise, people thought that the financial statements were the representation of the audit firm. They're not. They're the representation of management. All the auditors do is they render an audit opinion on the financial statements. That's the responsibility. Okay. So when we look at this heading, what does it say? It says management is responsible for the preparation and fair presentation of the consolidated financial statements in accordance with IFRS, and for such internal control as management determines is necessary to enable the preparation of financial statements that are free from material misstatement, whether due to fraud or error. In preparing the consolidated financial statements, management is responsible for assessing CIBC's ability to continue as a going concern, disclosing its application, matters related to going concern, and using the going concern basis of accounting, unless management either intends to liquidate CIBC or cease operations or has no realistic alternative but to do so, since those charged with governance are responsible for overseeing CIBC's financial reporting process. And so we're telling the reader now, oh, by the way, the financial statements are those of management, and by the way, the board of directors is responsible for overseeing the financial reporting processes, right? And ensure that, of course, the financial statements themselves are proper, correct, complete. So are the auditors responsible for their opinion? Yes, but there's a lot of other people, right, responsible for the audit as well. So I'm talking more about the audit process, right, than just the audit report. The next heading, you see auditors' responsibilities for the audit of the consolidated financial statements. So we have a paragraph that tells about the fact that management's responsible for the financial statements and the board's involved in overseeing management. Well, what are the auditors' responsibilities, right? So let's have a look at that. It says our Our objectives are to obtain reasonable assurance, right, about the consolidated financial statements as a whole, are free from material misstatement due to fraud or error, and issue an auditor's report that includes our opinion. Right? So that's our objective. Give an opinion. That's all we're hired to do. Reasonable assurance is a high level of assurance, but it is not a guarantee. Right? So we're telling them you can take a lot of assurance from our audit report, but it's not a legal guarantee, okay, that you can sue us on. It's not a guarantee that the audit conducted in accordance with Canadian generally accepted auditing standards will always detect a material misstatement when it exists. Okay, it's not, we will not always find material misstatement. Why is that? It's because when auditors do audits, they take some risk. Normally, auditors audit financial statements to a 95% confidence level. Auditors take a 5% risk that the financial statements contain a material error. Now, they do a lot of work, right, trying to ensure that that 5% does not happen. But sometimes, unfortunately, it does. Right? So we're trying to tell the reader here, right, that we think we've done enough work, you can rely on the numbers, but there is a chance there could be a material error. Now, it doesn't say that there's a 5% chance, does it? I think maybe in the future years, we're actually going to talk about this, right, in the auditor's report and tell the reader the level of confidence that they can have. Because when it says reasonable assurance, how much assurance is that? We're saying it's a high level. Well, why not say it's 95% level? Right? Actually tell the reader what it is. Okay. Now, in some cases, it's higher than 95. Sometimes it's 99, but almost all the time, it's 95%. And so I'm not sure myself, why not just tell the reader it's 95%? To me, that makes a lot of sense because then they can look at it and say, well, there's 5% chance it's wrong. How worried am I about that? Excuse me. When we say a high level, is 80% a high level? I would say yes. Is 75% a high level? Fairly high. How about 60%? Well, I'm not sure 60% would be a high level, right? You can see what the problem is, right? The lower we make the percentage, the more we start questioning, what's a high level, right? It's high, but how high? And is it high enough, right, for us to rely on the financial statements? So using words like high level, I still think that can create difficulties, right, for auditors. Okay. Now we go a little bit further and we want to tell the reader, well, what is an audit? What do we actually do? It says, as part of our audit, in accordance with Canadian generally accepted auditing standards, we exercise the professional judgment. You exercise professional judgment, and we maintain professional skepticism throughout the audit. Right? So we're telling them we actually use some judgment, right, as we're conducting our audit. It says we also, and then there's a whole bunch of bullet points here, right? We're telling the reader, let's look at a couple of these. It says we identify and assess the risk of material misstatement of the consolidated financial statements, whether due to fraud or error. Secondly, we obtain an understanding of internal control relevant to the audit so that we can design audit procedures that are appropriate in the circumstances. Thirdly, we evaluate the appropriateness of accounting policies used and the reasonableness of accounting estimates. So what we're doing here is we're giving the reader really a laundry list. Right? We're giving the reader a laundry list, trying to explain to them what it is that we do during the course of an audit. Going to the last bullet point, it says we obtain sufficient appropriate audit evidence, right, about the company in order to express our opinion. So again, that comes back to what we saw a few minutes ago in the actual report. The auditors say that we gain sufficient, meaning enough quantitatively. We gain appropriate evidence, meaning it's the right type, right? The quality of the audit evidence is satisfactory, right? So again, we're trying to communicate better, right? What an audit actually involves. The next paragraph, it says we communicate with those charged with governance. Who's that? That's the board of directors. Regarding, amongst other matters, the scope of the audit. That means how much work are we going to do in our audit, in what areas. We discuss the timing of the audit, when we're going to actually complete the work, and significant audit findings. So anything that comes to our attention during the course of the audit that we consider to be significant, we discuss with the board of directors. We also discuss significant deficiencies in internal control, because that might affect the numbers that appear in the financial statements. Right? So we want to make sure that the board of directors, as well as management, of course, is aware of these things. Okay. The next paragraph says we provide those charged with governance, being the board, with a statement that we have complied with relevant ethical requirements. So this is actually a legal requirement. Auditors each year must give a letter to the board of directors which says that they have satisfied all the relevant ethical requirements set by them by the professional bodies, including, of course, independence. Right? And then we'll just look at the last sentence here. It says the engagement partner on the audit resulting in the independent auditor's report, in this case, is Helen Mitchell. So again, this is something that's new, just in the last couple of years. The audit report used to just be signed by the firm, right? But as a result of, again, trying to better communicate, right, to the users of the financial statement, who's actually responsible for this audit report at the firm. Because when you sign Ernst & Young, well, who is Ernst & Young, right? If I wanted to call somebody up about this audit report, who do I call? Right? It doesn't say. Well, now it does say, right? You would call Helen Mitchell, right, if you had questions about the financial statements or the audit report. Of course, you have the fact that office, the Toronto, Canada, that's the office that's in charge of the audit, and as well, of course, the date of the auditor's report. So remember, the auditors will not sign the report until they have reviewed the entire annual report, management's MD&A, which is included in the annual report, right? And the board of directors must have approved the financial statements. So all those things, in this case, the year end is October 31. The auditor signed off on December 2nd, right? So basically 1 month after the year end date. So you might wonder, how can auditors complete their audit, within 1 month of the year end? How does that happen? So we're going to talk about that as we go through the course. And one of the things you realize is that, let me just give you an overview at this point. Again, we'll get into more detail as we go through the course. But for CIBC, usually what would happen would be the audit planning that goes on for the audit. Normally, in this case, would probably be done sometime in the May-June period, right? So for the October 31, 2020 audit, that planning started happening back in May or June of 2020. Then normally what would happen is the auditors would determine an earlier cutoff date. So normally for a large bank like this, it would take July 31st. And the auditors do a lot of procedures at July 31st, okay, as opposed to October 31st. And we'll talk about the mechanics of this as we get into the course. But they do a lot of their audit work at July 31st on the July 31st balance sheet, okay? And then they take that balance sheet and they do what they call a roll forward. So they take the July numbers and they roll them forward to October 31st. Of course, they'll look for trends, right, in the August, September, October timeframe that looks unreasonable. But I'll give you an idea. When I use the word roll forward, what does that mean? So let's say we were auditing loans receivable, right, at CIBC. And so let's say at July 31st, the loans receivable were $100 million. To roll forward that number to October 31, we would say, okay, in August, September, and October, how many new loans were issued? So let's say it was 25 million. So we take the July number, 100 million, we add 25 million, right? So those are the new loans. So that's 125 million. And then we would deduct payments received on the loans. So let's say that was 23 million. So we started with 100 million, we add 25 million to get 125 million, and then we deduct the payments received, 23 million. So our ending number at October 31st would be 102 million. So we've done a lot of work, right, on the July 31st number, a lot of audit work, and then we roll forward in the manner I've just described to get the October 31 number of 102 million. And then we do some limited additional audit procedures on that data at October 31, and then the auditors sign off their report for a large company like CIBC fairly quickly, right, within a month or so after the end of the year. But the trick is the auditors do a lot of their work not on the October 31st numbers. It's on data before that. Okay, so that's how they can get their audit opinion out so fast. Again, we'll talk more about those mechanics as we get into the course. Okay, but if you were working for a large company today, public company, or even a large private company, they would be working the same way. Okay, for an October 31st year end, they do work at July 31 typically, and then roll forward the data for 3 months. Okay. Now you might wonder, why is it 3 months before the end of the year? Well, that relates to the auditor's evaluation of internal control. Right? We just read a few minutes ago, the auditors are saying, well, we audit internal control, right, as part of our audit. Well, why do they do that? One of the reasons auditors audit internal control is to determine whether they can do work 3 months before the end of the year, right? So if internal control is strong, auditors say we can do work at July 31st and roll forward the data to October 31st. The reason we can do that is because we believe management system of internal control is very strong, right? And because it is very strong, we're going to rely on it as auditors, okay? If we thought there were some problems with management's internal control system, maybe we could not do audit work at July 31st. Maybe we would do it at August 31st. And so we would do a lot of work, audit work at August 31st, and then just do a 2-month roll forward. Roll forward September and October's transactions, okay? But this is an evaluation made by auditors during the course of their audit work. Of course, all these things, right, are discussed with management and the board of directors, right, so that everybody's aware what the process is, right? We want to have good communication to minimize the chance, right, that there's any surprise in the process, okay? So good communication is critical. And we saw during the in this various audit report that we just walked through, okay, that it's a lot about communication. Right? So again, in the old days, we only had a 2-paragraph audit report. We didn't say very much. Now we see, we look at here, this audit report ends on page 104. It started on page 101. So this audit report takes 4 pages. Now the first page was only about a half page. Let's just go back and look at it for a minute. The independent auditor's report, when we look at this, right, there's a lot of blank space here at the end of the bottom of the first page. So let's say maybe the audit report's actually, you didn't have that large space, it's actually maybe 3.5 pages long. But that's a lot longer, right? There's a lot more information given in the audit report compared to the old audit report where we only had 2 paragraphs, right? So we're constantly trying to improve the information, right, that we're giving to the users. And the idea is that if we give the users better information, right, on which to make their decisions, and if users better understand the risks involved, and if users better understand the fact that it's just not the auditors, right, doing the audit. The auditors have interacted with management, they've interacted with the board of directors, they've had communication with the board of directors. By the way, the auditors have to follow their ethical standards, right? So they're not too close with management, right? All this information, right, is being given in the audit report now. So part of the idea here is that if the auditors communicate better, hopefully they'll be sued less. And generally speaking, this is happening, okay, in the real world environment. The auditors are doing much better in terms of the quality of their audits. That's because of the Enron scandal and things we've talked about the other day, right? Where the U.S. government said, you as an audit profession have to do a lot better job. Right? So the quality of the audits have been improved significantly, especially with respect to how computer systems are audited, okay? But also with respect to board of director governance, right? There has to be much stronger governance in public companies today than there was just a few years ago. In addition to expanding the audit report, right, in the manner that we've talked about already today, right? We went from a 2-paragraph report to, right, a 3 or 4 page report, trying to communicate more information, trying to have a better understanding of the users with respect to what they're reading and the risks, right, that are inherent in what they're reading. Okay? Much different audit report, much better communication than we've had previously many years ago. And so as a consequence of that, auditors are getting sued less often today, right? Higher quality audits, better communication, right? They go hand in hand towards defending, right, the audit profession and ensuring that they're not sued as much, which of course, when auditors are not sued as much, that protects the reputation of the profession, right? If the auditors are getting sued all the time because they're not doing a very good job, that's very costly, but it also damages the reputation of the profession. How many people are going to want to rely on auditors, right, if their work is sloppy, negligent? The auditors could really hurt themselves if they're getting sued too much. So it's in the auditor's own best interest to do a better job, right? So they do a better job by doing better quality work, and of course, in the audit report, right, that we've already reviewed. Okay, so I've probably gone on for about 40 minutes, 45 minutes, something like that. So what I'll do is I'll just take about a 5 or 6 minute break, okay, and give you guys a chance to rest up for a few minutes. And then I'm going to continue on with the PowerPoint. Okay, so I'll be back in about 5 minutes or so, and we'll start into the PowerPoints. Now that you've had a chance to see what an audit report actually looks like, it sets context for what I'm going to talk about on the PowerPoints. Okay, so we'll see you in about 5 minutes. Okay, everybody, we'll continue on now. As I mentioned, having reviewed the auditor's report now for CIBC gives us some context, right, in which to walk through the PowerPoints for Chapter 4 in the text. As you can see, it's entitled Reports on Audited Financial Statements. Again, I'm just going to skip over the learning objectives. We'll just deal with that as we go through the material today. So the essentials on the report on the audited financial statements. It says the independent auditor's report. We saw that right in CIBC's report. It said independent auditor's report right at the top of the page. So the independent auditor's report on a company's financial statements is a standardized public statement using standardized wording. Okay, so all that wording that we saw, the headings, that's all set out in professional standards. So that's how auditors know what the headings should be, right, in the standard report. As we saw, it states the auditor's opinion on whether the financial statements are presented fairly. We saw in CIBC's case, it said that the financial statements did present fairly. Of course, management and the board of directors do want, all right, an auditor's report which states that the financial statements present fairly. Why? Well, what happens if the financial statements don't present fairly? Right? Somebody's not going to be happy, right, with respect to the users. And if the users suspect they can't place confidence on the financial statements, how are they going to make decisions, right? So it's very important, actually, that management and the board of directors work closely with the auditors to ensure that the auditors are in a position where they can give a what's called an unmodified or clean opinion or standard opinion on the financial statements. And as is stated here in the last bullet point on this particular PowerPoint, forming the audit opinion is the goal of the audit. Right? When the auditors are retained to audit the financial statements, the output of their work is the auditor's report. That's all they're really doing. But they have to gather sufficient appropriate audit evidence, right, to have a basis for their opinion. So let's talk about the various types of audit opinions. And I've already alluded to the fact that in most cases, the audit opinion is what's called an unmodified, unqualified, or sometimes referred to as a clean audit opinion. It's the most commonly observed. Why? Because it's the one that management and the board of directors wants. It's normally the one that the auditors ensure that they can supply, right, by getting sufficient appropriate audit evidence. You'll note there's a point here, it says required by security regulations. Well, of course, government bodies which are overseeing the public markets expect management and the board of directors to do everything in their power so the auditors can give an unqualified or unmodified opinion on the financial statements. If something other than an unqualified or unmodified opinion is given, it's an indication that something is wrong. Okay, so I'm going to say probably 99% of the time, auditors do give an unqualified / unmodified or clean audit opinion. However, circumstances may arise in which they have to give some type of modified opinion. Okay, so when we talk about modifying the opinion, we're talking about giving an opinion other than unqualified or unmodified. So where the auditors have to modify their opinion, they might have to modify their opinion. It's called an audit qualification. Okay, and two circumstances exist which may lead to an audit qualification. The first one, if there's a violation of generally accepted accounting principles. So for public companies, we know that they must follow the IFRS rules. So if the auditors determine that management had not followed the IFRS rules in the financial statements, so the financial statements do not present fairly, it's potentially a case where the auditors would have to qualify their audit report. So for example, if let's say the inventory, right, under IFRS, inventory should be recorded at the lower of cost and net realizable value. But let's say management did not do that. Let's say that the cost was 20 million, the net realizable value was 18 million. So there should be a write down of inventory. But if management decides they're not going to write down the inventory, and that $2 million write down is material to the financial statements, then the auditors would normally qualify their audit opinion. Okay, so GAAP violation is the first type or first reason for an audit qualification. The second reason would be what's called a scope limitation. So we already saw in the auditor's report, they state that they gather sufficient appropriate audit evidence. But what if they can't? If they can't obtain sufficient appropriate audit evidence? If they can't obtain the information that they need, that's called a scope limitation. So again, if the auditors cannot obtain the right amount of information or evidence they need or the right quality, and assuming the effect on the financial statements is material, then they would have to qualify their audit opinion because of a scope limitation. Okay. Now, when I'm talking about qualification of audit opinion, okay, here's an example of the wording. So let's go back to the GAAP violation. So if management didn't write down that inventory, right, by $2 million that I spoke of, an audit qualification would say something like this: except for inventory, which should be written down by $2 million, the financial statements present fairly. Right? You target in and you tell the reader inventory is too high by $2 million. Okay. With respect to a scope limitation, let's say that the auditors were trying to contact a customer, right, of the company that they're auditing, and they can't contact the customer for some reason. Let's say the account receivable from that customer was $2 million. So the auditors could not gather sufficient appropriate audit evidence about whether that $2 million is going to be collectible or not. So in their audit report, they would say, except for customer X, right, account receivable of $2 million, which we could not contact, these financial statements present fairly. Right? Again, you can zero in on what the problem is. Okay. Now, in both those examples where you can identify what the problem is, even though it's material, okay, we do express an audit qualification by using the words except for, right? So except for inventory being overstated, except for the fact we couldn't obtain information from the customer about this account receivable, the financial statements present fairly. However, if the GAAP violation or the scope limitation is not only material, but we use the word pervasive, right? If it affects many items in the financial statement, such that the financial statements taken as a whole do not present fairly, okay, then in that case, we have to do one of two things. So let's come back to the GAAP violation. So let's say that management refuses to record the inventory write-down of $2 million. Let's assume that management refuses to record additional depreciation, right? They should be recorded of $1 million. Okay, and let's assume that management refuses to increase the income tax expense, which should be recorded of $1 million. So we have three errors, three GAAP violations. Are they each material? We'll assume yes. But in total, many accounts are affected. Right? Inventory is affected by the inventory write-down. Cost of goods sold will be affected by that. Income taxes will be affected by that. Depreciation is wrong, so the net book value, right, of the depreciated assets is wrong. The depreciation expense for the year is wrong. Okay, our income tax expense for the year will be wrong as a consequence, right? So you start getting the idea. There's so many things that are wrong, and they're all GAAP violations, right? We're not doing the accounting properly. but the effect of the gap violations is pervasive, right? There's so many things that are wrong. The financial statements do not present fairly. So where you have a gap violation, which is material and pervasive meaning many items are affected, resulting in the financial statements not being presented fairly, the auditors in their report give what's called an adverse opinion. Okay, adverse opinion. An adverse opinion just means that um, the financial statements do not present fairly. Okay, they do not present fairly. And I just noticed my computer has just frozen up. So what I'm going to do is I'm just going to step out of the class here for a minute, reboot my computer, uh, and then I'll come back. And then, as we were just discussing before we had to reboot, if the financial statements do not present fairly because the gap limitations or violations are so material, the financial statements are affected in a pervasive way, meaning that they're not useful as a whole, then the auditors state in their audit opinion, these financial statements do not present fairly. Well, you can imagine, right? When you say financial statements do not present fairly, that's going to be a problem, isn't it? For the users. They need a financial statement that does present fairly so that they can make the decisions that they need to make. In addition, we may have a scope limitation, which is both material and we use the word pervasive, right? It affects too many numbers. So let's say that um, management has used the going concern basis of accounting, but the auditors have determined that the going concern basis of accounting is not acceptable in the circumstances because the company is going to have to close up, okay, and stop business. They can't raise additional capital. They're going to have to close the company. In that case, the going concern assumption does not apply, and the assets and the liabilities should be measured on what we call a liquidation basis of accounting. Liquidation basis of accounting means that what can we sell the assets for, right? In a fire sale, basically. And what debts would we have to pay from those proceeds? So the numbers, right, would look very different if we're not a going concern. And so in that case, if we have a scope limitation, which is material and pervasive, we have to give what's called a disclaimer or denial of opinion. Right? So the auditors in that case simply say, we deny an opinion on the financial statements because, right, we can't get enough information to satisfy ourselves if the company is a going concern or not. Management's saying it is, the auditors are saying we don't have enough information to support management's view. And in fact, the auditors are probably coming to a conclusion they don't think it is. Right? So if management can't supply enough information, that's a scope limitation, but it's pervasive because the basis of accounting may be wrong. So in that case, you would deny an opinion. You say, we don't know if the numbers are right or not, right? Because we can't get the information that we need. Okay. There are different types of assurance that auditors give in their reporting on financial statements. And so a couple of these we're going to talk about later in the course. I mentioned that auditors, of course, most of what they do is audit work, but they also do other types of engagements. So this slide talks about the types and levels of assurance that auditors can give with respect to a set of financial statements. So for a public company, of course, financial statements actually have to be audited. So the auditors in that case, it says, are giving reasonable assurance, which is referred to as a high level of assurance. It's a high level of assurance because, as I mentioned a few minutes ago, auditors normally audit such that they're 95% confident that the financial statements present fairly. 95%, it's not 100%, but it's still high. The second type of engagement that they might do is called a review engagement. Okay, so much less work is done. Again, we'll talk about this at the end of the course. A lot less work is done. It's much cheaper for the client, okay, in terms of review engagement. But the consequence of that is the auditors will give a lower level of assurance, okay, what they call a moderate level. Now, you won't see anywhere in writing what a moderate level of assurance is, but I'll tell you from day-to-day practice in an audit firm, by moderate assurance, we usually mean assurance in the range of approximately 60%, okay, 60%. So an audit is 95%, a review engagement normally around 60%. So it's a lot less, isn't it? A lot less assurance. The third type of engagement that an auditor might do is something called a compilation. And in a compilation, we give actually no level of assurance, okay? And it actually says in the report that we don't give any assurance on the data that's been presented. A compilation is essentially normally for a very small client. You put together some financial statements based on the bookkeeping, right, done by the client. But even though you present a balance sheet and an income statement, you're not going to express any assurance as to whether the numbers are correct or not, because your involvement with the data is so low, right? You don't want to give any assurance to the reader of the data. And again, we'll look at the types of report issued for both a review engagement and a compilation later in the course, but it's much less extensive, right? CIBC's report we saw was 4 pages, right? In a review engagement, even for CIBC, if you did a review engagement, the review engagement report would only be 1 page long. The compilation report would be much less than 1 page long, right? So it's much less involvement, much less cost, right, for management. It's just that the public markets demand, right, that financial statements must be audited if you're going to list your stock on a public stock exchange. But in most cases, for private companies, they do a review or a compilation because much less cost, right? So for family-owned businesses in particular, they're looking for lower cost alternatives, and the review and the compilation are normally the engagements that would be done in those types of scenarios. The association framework, again, association is a word that if an accountant auditor is going to be involved with financial data, we say that you're associated, okay? And any time that an auditor is associated with financial information, you have a responsibility to make sure that the information is correct, okay? And that it's accurate, and you're not associating yourself with any information which you know is false and misleading, right? Auditors, of course, have to follow the rules of professional conduct. You have to have integrity, be objective, right? So you can't be associated with anything that's false or misleading. When I was, well, even still today, because I practice on a part-time basis, but when I was practicing full-time, clients would ask me, can you do this? Can you do that? I was always concerned, right? Anytime you put your name on something, now you're associated with it, right? And that has legal consequences if the information is incorrect. So you always have to be very careful when you're associated with certainly financial information if you're an accountant or auditor, but even in our everyday lives, right? You should never sign anything unless you feel that the information in the document you're signing is accurate. Okay, so this little piece on association here, the PowerPoints, you're not responsible for that. Okay, in terms of the actual association rules. Okay, so we're just going to skip over these few PowerPoints because we would just want to talk about reports, audit reports in particular, but these other reports as they relate to level of assurance. So on PowerPoint 12, we see exactly what we just talked about. Audits give a high level of assurance. So as we saw in CIBC's report, we give positive assurance, right? We say, in our opinion, these financial statements present fairly. That's a positive statement. In a review engagement, because we are much less involved, right, with the numbers, we do much less work. We do give some level of assurance, a moderate level. But what we say there, sometimes we call this a negative type of assurance. In an audit, we give positive assurance because we actually state an opinion. In our opinion, these financial statements present fairly. But in a review engagement, we'll give moderate assurance, and we do that by giving what we call negative assurance. So in a review engagement, what we say is nothing has come to our attention that leads us to believe the financial statements are not in accordance with IFRS, for example. Okay, so nothing has come to our attention. Are we stating an opinion that the financial statements are in accordance with IFRS? No. What we're stating is that nothing has come to our attention that leads us to believe that the financial statements are not in accordance with IFRS, right? Nothing has come to our attention. Have we done more work? Could something have come to our attention? Possibly, right? But based on the amount of work done in a review engagement, in a report, we actually state nothing's come to our attention that leads us to believe the financial statements are not in accordance with IFRS. Right? We're not saying they are, we're just saying nothing's come to our attention that leads us to believe that they are not, okay? Called negative assurance. Compilation, we already said, we give no assurance, and in that report, we state there's been no attempt, right, to verify the accuracy or the completeness of the information, right? So in an audit opinion, we state the financial statements present fairly. In a review engagement, we say that the financial statements, right, are okay because nothing has come to our attention to lead us to believe that they're not okay. But in a compilation, we actually state, by the way, we haven't tried to verify the data, and we don't know if it's all recorded or not, right? No attempt, right, to verify accuracy or completeness of information. Now, sometimes we have a discussion around compilations. Do we actually give Do we say there's no attempt? Well, in a real practice scenario, you do make some attempt, right? Why? Because when you issue your compilation report, it's called, you are associated with the information. Right? Your name is on the report. So do you want it to be incorrect? No. So you do some very low level of work, right, on the numbers to satisfy yourselves that it is accurate. Okay, but it's a very low level of work. But from a professional viewpoint, your report actually states you've made no attempt, right, to verify the accuracy or the completeness. So in a real life scenario, what I normally tell students is the amount of assurance given is under 5%. Okay, so very, very low. But because accountants do not want to be associated with false information, they do a very low level of work, but very, very low. But from a professional viewpoint and from a legal viewpoint, you actually state in your report, hey, I don't know if the numbers are accurate or if they're complete. Right? So we're personally taking very little responsibility other than saying, yes, the format of the balance sheet is correct. The format, right, of the income statement is correct. That's about it. Okay. The standard report in the PowerPoint here that it's talking about, this helps because we've already looked at CIBC. And so in our standard report called an unmodified report or unqualified report as well, we saw there's an opinion, right? Opinion given, the financial statements present fairly. We give the basis of the opinion, right? Saying that we've done our audit in accordance with generally accepted auditing standards. We identify the key audit matters. There doesn't have to be any, but in a large company, you would expect there's probably several. Right? We identify management as being responsible for the financial statements as well as the board. And as we saw, there's a section that talks about the auditor's own involvement, right, with respect to the nature of the audit work that they did. Okay, so again, this PowerPoint's just talking about the type of information that's given. We've already looked at CIBC's report, so we can sort of fast forward a little bit through these PowerPoints. It says the first paragraph of the standard report indicates the audit was conducted, identifies the financial statements which were audited, like balance sheet, statement of cash flow, statement of income, etc. We saw that in CIBC's report. The opinion paragraph, we saw, it states the financial statements present fairly, right? Part of generally accepted accounting principles, though, is that the financial statement disclosure is accurate, right? So we didn't say anywhere that the financial statement disclosure is accurate, but part of generally accepted accounting principles is there's adequate disclosure, right? There's nothing missing that might change the decision of the person that is actually reviewing the information, right? So we express an opinion, right? In CIBC's case, the financial statements present fairly, right? But we don't give a reason for giving that opinion, right? Other than we do give a basis of opinion paragraph, which gives the rationale for that opinion. The key matters paragraph, right? We already saw in CIBC's case, talked about the allowance for credit losses, talked about the impairment issues, right? Talked about the valuation of derivatives, right? So it says the auditor is required to identify key audit matters such as what? Difficulties in auditing the going concern. So if you had information that might lead you to believe the company might not be a going concern, right? Any issues you had there. Accounting estimates with significant risk. So for example, right, CIBC said, oh, credit losses might be a problem. Derivative valuation might be a problem, right? And then it says issues of significant public interest, if any. So public interest would relate to if you're auditing a bank, for example, or a not-for-profit. There may be things that you want to bring to the attention of the reader. But in a public company that's a for-profit business, typically you wouldn't have anything there. The key audit matters section says may include disclosures of key assumptions, such as the disclosure of a range of possible outcomes or other qualitative and quantitative disclosures relating to key items of uncertainty. So again, in the report for CIBC, we saw it talked about the significant uncertainties, but it also said, here's how we address them, right? So the reader can look at that information and say, am I satisfied? Or if I'm not satisfied, maybe I have to make some adjustment to these numbers myself, right? And then decide what you feel an appropriate adjustment might be. We saw there's a paragraph, right, that talks about management being responsible for the financial statements, okay? And not only responsible for the financial statements, but the report also said management's responsible for the system of internal control as it relates to the preparation of financial statements. So this is something yourselves, right? If you get into a position where you actually have to sign a financial statement one day, if you're a CEO or a CFO for a company, right, you're going to have to sign off that the internal control system is sufficient to detect errors and to correct errors if, right, they're found, whether due to fraud or error, fraud or outright honest error. So it's about the internal control system. We haven't talked about that yet in the course. We will be talking about it, right, in the next few chapters. We'll get into that. But the internal control system is one of the key ways that management produces accurate financial information, and it's one of the key factors in actually operating the business. Right? You have to have a strong system of internal control. And again, we'll talk about later in the course as to what that is. We saw the paragraph that talks about what the auditor's responsibility is. Right? We have to follow the professional standard. It says that we follow generally accepted auditing standards. And what did those standards require? Auditors have to be trained and proficient. We're independent. We do professional care. Those are the words we talked about the other day, right? That are in the code of conduct, right, for CPAs. The work has to be properly planned and people supervised. We also have to have a sufficient understanding of internal control, and we have to obtain sufficient appropriate audit evidence, right? These are all things, right, that are reflected in the code of conduct and in the standards, right, that we've talked about already in previous chapters. The audit report qualifications, I've already mentioned those today, right? So again, we have the unmodified or unqualified or clean audit opinion, right? That's the one that's given 99% of the time. Or we may have to qualify, right, the audit report. And I've talked about the circumstances in which that would have to be done. Right? So we can have a departure from GAAP, right, where it's material, but we can isolate the accounts affected. Right? In that case, we qualify the financial statements and we say except for, right, except for a particular item, such as except for inventory, which is overvalued by $2 million. These financial statements present fairly. Right? Everything else in the audit report is standard other than that. Or again, if we had a scope limitation, right, where we couldn't get information about that account receivable, except for our inability, right, to contact Mr. X, who owes $2 million, these financial statements present fairly. Right? It's the idea where you can isolate the problem. You use the words except for, and that's called an audit qualification. It might be because of a GAAP limitation, such as the inventory not being written down, or it might be because of a scope limitation. We can't get sufficient appropriate audit evidence, for example, in connection with that customer that owes us money. In addition, we said we might have an adverse audit report, right? The adverse audit report, that was the example where there were multiple errors, right, in the accounting. Depreciation wasn't recorded, tax provision should have been increased and it wasn't, inventory write-down wasn't recorded, right? So all of these departures from GAAP are super material, right? Or they're so significant when taken together, they overshadow the financial statements themselves. It means it's pervasive, right? Numerous accounts are affected, financial statement ratios are affected. So in total, right, we're going to say the financial statements do not present fairly, right? Because so many numbers would have to change a financial statements being produced, which is really of no use, right? So the auditors state the financial statements do not present fairly. And then in addition, if we have a scope limitation where we can't get sufficient sufficient audit evidence because we can't get the right type of evidence or we can't get the right amount of audit evidence, we have to give a denial of opinion, right? So we would have to say, except for my inability to obtain sufficient information, sorry, if I can't gain sufficient information about the company being a going concern, right? And of course, as I mentioned a few minutes ago, all the assets and liabilities, right, in terms of how they're recorded would change, right? I would have to say, I deny an opinion on the financial statements. Why? Because I need more information from management to justify their use of the going concern assumption, and they're not giving it to me, right? So do the financial statements present fairly or not? I don't know. I need a lot more information, right? I have my suspicions, so I'm going to deny an opinion. I need more information to make a decision as to whether the financial statements present fairly or not. You might find this PowerPoint number 21 helpful for you with respect to what the type of audit reports, okay, that we've talked about today. So again, the standard report, sometimes called a clean audit opinion, unqualified or unmodified opinion, that's the one that's given 99% of the time. That's like CIBC's report that we talked about today. This PowerPoint number 21, if you have a gap departure, right, and you can, it's material, okay, that it says lesser materiality, it's material but not pervasive, okay, you'd be in the middle column. Then your report is qualified and you say, except for inventory, which is overstated by $2 million, the financial statements present fairly. To the right column, right, where you had multiple gap problems, depreciation not recorded, tax provision too low, inventory recorded too high, so many numbers would change. All the numbers, right, the financial statements taken as a whole do not present fairly, and that's what you would say. You would give an adverse opinion. The financial statements do not present fairly. Scope limitation, again, where the auditor cannot get sufficient appropriate audit information. Again, if the amount is material but not pervasive, the account receivable can't be verified, okay? We would give audit qualification, again, except for, right, our inability to collect information about whether we can collect the amount due from Mr. X, right? These financial statements present fairly. It's a specific amount, we can isolate it. On the other hand, right, if it's the potential problem is so material to affect the financial statements as a whole, so if management cannot give us more information about whether the company is a going concern or not, that could be pervasive, right? It affects so many numbers. In that case, we have to deny an opinion where the scope is pervasive, right? The scope problem is pervasive. We have to give a denial. Now, the last point we hadn't talked about here in this PowerPoint, but just to mention it, it talks about uncertainty, right? When there's a lot of uncertainty in the financial statements, can we give an unmodified report? And the answer is yes, right? And we saw in CIBC's report, there's a lot of uncertainty, right? In the key audit matters, right? They identified 4 different items, right? Allowance for credit losses, tax provision, derivative accounting, goodwill impairment. Those are all things that are uncertain. But assuming that management's disclosure is adequate in the areas of uncertainty, okay, we can still give an unmodified audit opinion. Okay, so it's just not a case where, because there's so many uncertainties, that we have to somehow change the audit report. No, it's about, is there adequate disclosure or not in the financial statements? Okay, so this is very unusual that you'd be dealing with this last case. Okay, usually you're dealing with, if there's a problem, it's either a gap departure or a scope limitation, and the only issue there is, assuming it's material, you have to decide, is it pervasive? Right? Now, how many times do you see an adverse opinion? Next to never, right? Just do a Google search if you want to today, put in, examples of adverse opinion and see if you can find a real life company with an adverse opinion. You might not be able to find one, right? Try doing the same thing for denial of opinion. Right? You might not be able to find one. You might find a small number, but they're very, very rare, right? Why are they rare? Because it's not the type of audit opinion that the users of the financial statements want. They want a clean, standard, unmodified audit report. So that's the goal of the auditors. That's the goal of management and the board of directors, certainly in a public company and even in a private company. Significant matters. So this is talking about the other information, right? You remember in CIBC's report, it had an other paragraph, talked about the annual report, the fact that the auditors took no responsibility for that, even though they had reviewed it, right? So that's what this last couple PowerPoints is referring to. Again, I would say PowerPoint 22, 23, and 24, you're not responsible for, okay? So the main thing from today is just know the standard form of reporting, as we talked with CIBC. I walk through the CIBC report, be somewhat familiar with the various headings, right, the various captions of the audit report, and then as well the discussion we've had today about the types of audit report. Again, to summarize that, the most common type that's issued 99% of the time is the unmodified, clean audit report. That's where the financial statements present fairly. If you have a gap departure, which is material, you would give an audit qualification where you say, except for a particular item, the financial statements present fairly. If the gap departure is so material and it's pervasive, right, meaning the financial statements as a whole are meaningless, then you say the financial statements do not present fairly, right? That's called an adverse audit opinion. If you have a scope limitation where you cannot get sufficient appropriate audit evidence, but you can narrow it down to one area or two areas, then you might be able to give an audit qualification, right? You say, except for my inability to obtain information on the collection of the account receivable of $2 million, these financial statements present fairly, right? You can narrow down what the scope problem is and make it clear to the reader. On the other hand, if you can't get enough information about the company being a going concern, right, and because so many numbers could be affected, you don't know if the financial statements, right, are materially correct or not. Okay, you think there's a material error, but it's pervasive because so many of the numbers could change. In that case, you have to deny an audit opinion. Right? You would just say we deny an opinion on the financial statements. Okay. So a number of different types of reports. Again, very unusual for you to see any type of report other than the standard report. Okay, so I think we're done for today. Thanks everybody for coming to class. Appreciate your time. Again, if you have questions at all when you review this lecture, feel free to send me an email. I've had a couple of students contact me already just with some earlier questions. Nothing of importance for the whole class. If there is anything that comes up, I'll certainly pass that along to the whole class. But again, feel free to contact me if you have questions about the material presented, or even how we're moving forward in the course about exams and things like that as we move along in the process. Okay, as we get closer to the midterm exam, and I'll be doing the same thing for the final exam, I will give you some insight into the format of the exam, okay, so that you know what to expect. Okay, thanks everybody, have a good day, and we'll see you next Monday. Take care.